Good afternoon, everyone, and thank you for joining us. We are glad you could spend some time with us today for a conversation on a topic that may seem technical at first glance, but it can really have a meaningful impact on your long-term financial plans. The 2026 contribution limit updates and what they mean for your savings strategy. At Bryn Mawr Trust, we believe in staying informed about changes like these is an important part of making thoughtful, proactive decisions. Whether you're building wealth, preparing for retirement, or helping the next generation get started on the right path. The changes for 2026 are really being driven by three things. The first is inflation adjustments to keep pace with rising costs. Secondly, the continued rollout of the Secure Act 2.0, which was designed to expand saving opportunities. And lastly, a broader policy push to help Americans build stronger retirement readiness. For today's discussion, I'm pleased to be joined by my colleague, Michael Perigian. Michael's a valued member of our wealth team and brings a CFP designation, along with deep expertise in retirement planning, tax-efficient saving strategies, and helping clients translate complex rules into practical decisions. He works closely with individuals, families, and business owners to design strategies that align savings opportunities with long-term planning. And most importantly for you, he has a great ability to make technical topics accessible and actionable. Good afternoon, Michael.
Good afternoon.
In today's session, we'll walk through key updates that you'll need to navigate the year ahead. We'll start with what's new for the 2026 contribution limits, then explore strategic planning implications these changes create. From there, we'll highlight the most important tax and filing considerations to keep on your radar, and we'll wrap up with clear, actionable planning steps you can take, followed by real-world case studies and illustrations that bring these concepts to life. Before we begin, let's take care of a couple quick housekeeping items. First, please feel free to use the Q&A button at the top of your screen to submit questions at any time during the webinar. We'll do our best to address these questions during our Q&A session later on in the production. Secondly, this session is being recorded, and we'll send you a link to the recording along with additional resources after the webinar. And lastly, please note, today's webinar should not be construed as legal, tax, or financial advice. Please consult your personal advisor to determine how this information may apply to your own situation. All right, Michael, thanks so much for being here. Let's kind of kick off the bat and just start with what's new in 2026.
Sure, Brian. Thank you very much. So let me highlight the key updates to retirement contribution limits for 2026, changes that expand savings capacity and create additional planning opportunities. So beginning in 2026, the employee elected deferral limit rises to $24,500, an increase of $1,000 over last year. The total annual contribution limit, now this is combining employee and employer contributions, also increases, moving from $70,000 to $72,000. These adjustments provide additional flexibility for high-earning participants to enhance the value of employer plan benefits. So for individuals age 50 and above, the standard catch-up contribution increases to $8,000. The enhanced super catch-up, available to participants ages 60 through 63, remains unchanged at $11,250 for 2026. This structure continues to offer meaningful opportunities for late career acceleration of retirement savings. Traditional and Roth IRA contribution limits rise to $7,500 in 2026. In addition, the age 50 and over IRA catch-up contribution increases to $1,100. These incremental increases help ensure IRA savings opportunities continue to keep pace with inflation. The income phase-out ranges for traditional and Roth IRAs, as well as eligibility thresholds for the Savers Credit, are also all increasing for 2026. These adjustments may broaden access to tax-advantaged savings and credits, particularly for households on the cusp of prior income limits. So collectively, these updates offer a stronger framework for retirement readiness with higher contribution limits and expanded eligibility, enhancing planning flexibility for a broad range of investors.
That's great information, and particularly again a lot of the things that we kind of take for granted there. So let's sort of shift from the numbers to sort of what these increases actually mean for our clients and for long-term planning, Michael.
Yeah, absolutely. I mean, first, the higher contribution limits expand the amount that clients can shelter in tax advantage accounts each year. Even seemingly modest annual increases compound meaningfully over long time horizons, creating larger retirement balances and improved financial security. Second, these expanded limits create critical planning flexibility, especially for individuals who may be starting late, have had interruptions in their savings trajectory, or are working that are close to these retirement gaps. So ultimately, these adjustments are not just incremental changes. They enhance the strategic levers that we can pull to improve outcomes across a wide range of client scenarios. So from a planning perspective, it's important to tailor these strategies by life stage. So for our younger savers, say under age 50, the priority remains maximizing annual contributions, now up to that new $24,500 limit. So establishing these high contribution habits early can really be meaningful to amplify these long-term compounding effects. For mid-career savers, ages 50 to 59, the incremental catch-up contribution becomes a key planning tool. These additional dollars can help bridge savings gaps and strengthen retirement readiness during prime earning years. And then for our older savers, particularly those ages 60 to 63, we have the super catch-up. And that provides an elevated window to accelerate savings at a critical moment nearing retirement. Leveraging this short-term opportunity can materially enhance retirement outcomes. So in short, these 2026 adjustments give us expanded planning capacity and more targeted ways to help clients make up ground, amplify long-term growth, and optimize the tax advantages available to them.
Great, and really, really well summarized there. So, Michael, as we assess the 2026 contribution landscape, there are several tax and filing considerations that will really directly influence how clients should structure their saving strategies. Maybe you could highlight a few.
Yeah, sure thing, Brian. So first, the Secure 2.0 Act introduces an important shift for higher income earning clients. So the catch-up contributions must be made on a Roth basis when prior year wages exceed the designated threshold that's currently $150,000. So this change alters not only the timing of the taxation, but also overall retirement tax planning. Clients accustomed to the traditional pre-tax catch-ups will now need to consider the immediate tax impact of the Roth contributions and the long-term benefits of the tax-free withdrawals. Beyond the new rule, the broader Roth versus traditional decision continues to play a crucial role in retirement and Medicare planning. Roth assets can help manage taxable income in retirement, support IRMA management, and offer greater flexibility for withdrawal strategies. For many clients, especially those expecting higher taxes later or seeking predictable income streams, Roth contributions may offer a meaningful advantage. It's also essential to coordinate these rules with the specifics of each of the client's employer plan. Not all employer plans offer the Roth option, which has direct implications for clients required to make the Roth catch-up contributions. So in such cases, the absence of a Roth feature can limit the catch-up eligibility until the employer updates their plan. So that's why we recommend reviewing plan documents early in the year, well before clients are, making these contributions. We have to understand the plan limitations and administrative timeliness to ensure we can proactively guide clients, prevent compliance issues, and position them to take full advantage of the updated contribution framework. So taken together, these tax and plan design considerations underscore the importance of early planning, precise coordination, and personalized guidance as we help clients align their retirement strategies with the evolving regulatory environment.
Yeah, it really is. And I would say, like, with these expanded contribution limits and some of these ever evolving tax rules, it's really important that we translate these changes into kind of concrete, high impact actions our clients can take. Maybe you could walk through couple key planning steps that will help clients fully capture the benefits of these increases, Mike.
Yeah, Brian. So first, we want to ensure that clients are optimizing their contribution rates, right? So small incremental increases to the percentage of the salary they contribute can make a difference between falling short of the new maximum and fully capturing the expanded limits. Even a 1 or 2% increase implemented early can materially improve long-term outcomes. So to make this easier, we encourage clients to automate those contribution increases, particularly tying them to their annual pay raises. This creates a seamless path to higher savings without requiring clients to re-engage each year. It's a simple but powerful behavioral tool that keeps their retirement strategy aligned with the rising limits. Beyond the employer plans, we should reinforce the value of incorporating additional tax advantage accounts. Traditional Roth IRAs, they remain essential supplements, helping clients diversify their tax exposure and maximize total retirement savings. Health savings accounts also deserve greater attention, particularly for clients anticipating significant healthcare expenses later in life. HSAs offer a triple tax advantage and can effectively serve as a dedicated retirement health fund. Coordinating contributions across these vehicles ensures clients are taking full advantage of every opportunity available to them. Of course, contribution optimization must be balanced with the broader financial priorities a client may have. So we help clients align the increased retirement savings with emergency fund needs, debt repayment, and other near and midterm goals. So a balanced approach ensures savings are sustainable, not burdensome. Now, to support this, we can equip clients with practical tools and planning resources. We use a platform called eMoney. They offer budgeting modules, cash flow projections, interactive worksheets that make it easier for clients to visualize trade-offs and maintain their progress. These tools elevate the advisor-client engagement and create a more disciplined, proactive planning experience. Ultimately, these steps help translate policy changes into meaningful progress. By optimizing contributions, integrating complementary savings vehicles, and supporting clients with robust planning tools, we can ensure that they capture the full benefit of the 2026 environment and stay on a confident path toward retirement readiness.
Great. I do think a really good actionable planning step outlined there. So I really appreciate that, Michael. But sometimes, and if you're like me, if many people on the call are like me, sometimes these concepts really come to life when you look at real world examples and can kind of think about it a little differently. So maybe we could walk through some case studies or hypothetical examples to kind of illustrate how these impacts can play out in practice. So, Michael, when we prepared for this, I think and I think you outlined this well. There's kind of three life stages. Maybe we start with, and imagining a 45-year-old in their peak earning years who's really committed to maximizing their 401k each year. They're still relatively young. They have two decades ahead. Combining the higher contributions and compounding at this age can really be incredibly powerful. So, as you mentioned, small increases can translate to meaningful difference in retirement readiness. Maybe you can walk through this illustration a bit, Michael.
Yeah, no, absolutely. So, at this stage in life, clients still have roughly 2 decades of compounding ahead of them. So this is enough time for even these incremental increases in savings to materially influence long-term retirement readiness. And with the new 2026 limits, the opportunity becomes even more powerful. So for someone under the age of 50, the new maximum employee contribution is at $24,500. While they don't yet qualify for the catch-up contributions, consistently hitting this limit year after year creates a strong foundation for future growth. So this is also the point in a client's career where earnings tend to be most stable, allowing us to reinforce a disciplined savings behavior and lock in these high contribution rates that will compound over the next 20 years. And of course, we should not overlook the employer match. For many mid-career professionals, the match represents one of the most efficient returns available, essentially immediate risk-free growth. Ensuring clients contribute at least enough to capture the full match is the first priority. And then maximizing beyond that solidifies long-term outcomes. So in this illustration, we're focusing on a client who is consistently contributing the full $24,500 and capturing the full employer match. So when you project those contributions over 2 decades, combined with market growth, annual increases to the IRS limits, and the resulting balance demonstrates how meaningful this disciplined strategy can be. So let's walk through some numbers behind this example and show exactly how the expanded limits translate into long-term financial impact. So what makes this truly compelling is the effect of compounding. So at a 7% annualized return, simply contributing the max $24,500 every year for the next 20 years results in a future value of just over $1 million. That's the power of discipline, high-level savings sustained over time. Now let's layer in something many clients forget to fully appreciate, and that's the employer match. In our example, let's assume the client earns $150,000 and they receive a 3% company match. That's going to add an additional $4,500 per year to their savings. Now, that may not sound dramatic at first, but over 20 years, with that same 7% growth rate, those extra employee dollars help increase the future value to approximately $1,189,000. So in other words, that match alone adds nearly $185,000 or so to the client's retirement picture. It requires no additional out-of-pocket commitment and becomes one of the most efficient return-generating opportunities available. So that's the foundation right there. Maximize contributions, consistent time horizon, and a meaningful amplification from your employer matching dollars.
Those numbers are compelling. I mean, it's really amazing what just that small 3% company match means in the long term. It's pretty compelling. So let's kind of shift a little bit. Let's now move to a very different yet equally common client scenario, the late saver, right? Some people just don't really realize until they're much older the impact of compounding. So maybe we take a 55-year-old professional earning, let's just say $200,000, someone who may have started saving later in life and now really needs to accelerate contributions as retirement comes really into view. So maybe you can walk us through that, Michael.
Yeah, so at age 55, let's say she's eligible for the enhanced contribution limits, right? So under the 2026 rules, she could contribute up to $32,500 in a 401k. So that's the standard $24,500 plus the limit, plus an additional $8,000 catch-up contribution. So for someone who's closing in on retirement, this expanded ceiling is incredibly valuable. These final 10 to 12 years represent the last and often the most impactful window to boost retirement readiness. Now, here's the important nuance. Because of her income exceeds the Secure 2.0 Act threshold of $150,000, her catch-up contribution must be made as a Roth contribution. So that means she pays the tax today, but she's building a pool of tax-free dollars that can be strategically used down the road. So this Roth requirement actually creates planning advantages. Roth assets can help manage taxable income in retirement, reduce exposure to Medicare IRMA surcharges, and provide tax-free withdrawals at a time when flexibility matters the most. So while the initial tax hit may feel inconvenient, the long-term payoff can be meaningful, especially for late savers trying to optimize every lever available. So those clients who feel that they're behind, these combination of higher limits, catch-up contributions, and the Roth structure become a powerful accelerator strategy. So even in the mid, 50s, if you're starting then consistently contributing at that 32,500 level, can dramatically improve the outcomes over the next decade. It also gives us the ability to diversify their future income streams. So balancing the pre-tax versus the Roth versus taxable accounts in a way that creates real flexibility during retirement distribution planning. So in this example, we're focusing on how maximizing the 32,500 annual contribution paired with the Roth catch-up requirement helps a late-stage saver rebuild momentum and strengthen her retirement trajectory. So let's look at another of our 55-year-old catch-up saver, but at this time, assuming they're earning that $200,000 a year. Now, this is a reality for many late career professionals who are in their highest earning years, but may feel behind on retirement readiness. So at age 55, she can contribute the $32,500 annually to her 401k, even with just a 10-year window remaining. Maintaining that contribution level has a very meaningful impact. At 7% annualized growth rate, those contributions alone build to roughly $450,000 over 10 years. Again, this underscores the important message. Even late in a career, disciplined saving can still move the needle in a very significant way. So let's even factor in, on top of that, her employer match. So at 200,000 salary, 3% match adds an additional 6,000, bringing her total annual savings up to 38,500. With that match included, her projected 10-year balance increases to approximately 532,000. So that's an additional 83,000 in future value, driven entirely by employer dollars compounding on her behalf. So in other words, the match is no longer a small add-on. At this income level, becomes materially valuable accelerant. And remember, because her income exceeds the 150, her catch-up contribution must be made as a Roth contribution under the Secure 2.0 Act. So that means she pays taxes on those dollars today, but building a meaningful pool of tax-free assets for retirement. So even with a decade to go, a strategy built around maximizing contributions, capturing the full employer match, and incorporating Roth catch-up dollars can significantly reshape a client's retirement outlook. It shows that for late starters, the final stretch can be incredibly productive when approached with discipline and strategic intent.
Absolutely right. So let's look at our final example and where we focus on a client who's right really on the doorstep of retirement. A 60-year-old earning now, $250,000 a year. She's in her peak earning years, but time candidly is short, right? From an employment perspective. With only 5 years to go, assuming she retires at 65, her goal is real simple, right? Finishing strong. So maybe you can walk through that sort of finishing strong example for us, Mike.
Yeah, absolutely. So, at age 60, she becomes eligible for what's known as that super catch-up and an enhanced savings opportunity for exclusively available to those individuals 60 to 63. So for 2026, that brings her total employee contribution limit up to 35,750. So that's the standard 24/5, and then the additional 11,250 in those catch-up contributions. So this is actually one of the most valuable short-term opportunities in retirement planning. It gives late career earners a final runway to accelerate their savings while income is the highest. And because her income exceeds the 150, again, these catch-up dollars must be made as Roth contributions. So while that means paying tax now, again, still building that powerful pool, tax-free assets for retirement. And as far as the assets, they can really help manage required distributions, control that taxable income, and hopefully avoid Medicare IRMAA surcharges later in life. So for many clients at this stage, Roth dollars become an important tool for shaping what that cash flow flexibility in retirement look like. So even that short window, it matters. So again, let's drill down. Let's look at some numbers. So if she contributes the full 35,750 per year, we're assuming that 7% annual growth rate. Those contributions alone grow to approximately $205,000 over 5 years. So now let's layer in that employer match, right? So at that 250, that 3% match, let's add in that another 7,500 each year, bringing her total annual savings to about 43,250. So with that additional support, her 5-year balance climbs to just about 250,000. That's more than 43,000 increase purely from the employee dollars compounding over that very short period of time. And again, the theme, this example, finish strong, even with just 5 years remaining, maximizing contributions, especially the super catch-up, and capturing the employer match can materially strengthen a pre-retiree's financial position. So for those clients who feel like they might be running out of time, this strategy demonstrates that the final stretch can still be incredibly productive when approached with discipline and a clear plan.
Now, and I think those three examples really help try to drill the point down. I think it's very conceptual when you start to talking about some of these changes, but when you layer in the strategies, you layer in some of the catch-up provisions that are allowable, and then add in that employer contribution at a certain growth rate, it really is, at least to me, becomes a lot clearer and is really helpful. So thanks, Mike. I really appreciate it.
Yep, sure.
So why don't we stop there? We'll pause for a second and we'll open it up for some Q&A. For those on the line, as a reminder, to ask a question, let's click the Q&A button at the top of your screen and just type in your question into the space that you're prompted to right on the screen. We have a couple of questions that came in ahead of time, and maybe we'll start with those, Michael, and then maybe let some of the other questions queue up, and we can address those once we walk through some of these pre-submitted questions.
Sure.
So again, hit that Q&A button, and I'll take a look at those. But let's start with our first pre-submitted question. I'm over 50. How do the new 2026 catch-up rules affect whether I should contribute to a Roth or traditional? I think we touched on this, but maybe you can sort of walk through this a little bit more, Michael.
Yeah, we did. So under the Secure 2.0 Act, it's based on your prior year wages. So if they exceed 150,000, then your catch-up contributions must be made as Roth. That's for starting this year. So that means that those dollars are taxed today, but they will grow on a tax-free basis and can be withdrawn tax-free in retirement. So if you're under the income threshold or your employer plan doesn't support the Roth, you may still be able to use the pre-tax catch-ups, depending, again, on the plan design. So the Roth requirement creates this planning opportunity related to tax diversification in retirement, IRMA, which is the income-related monthly adjustment amount, and predictable tax-free income later in life.
All right, great. So let's move on to number 2. So the second question that came in ahead of time is, my employer, and you touched on this, my employer doesn't currently offer a Roth option. What happens to my catch-up contributions if they don't update the plan in time for 26? Actually, this is probably something that many clients are that have these types of plans. Like, what do they do?
Right. Yeah, it's important. This is a key implementation issue. And if your plan does not have the Roth feature and your income is above that 150 threshold, you may be temporarily unable to, make that catch-up contribution until the plan is updated. So many employers are in the process of adding this Roth feature because of requirement, but timeliness, varies. We're not really sure. So this is why it's important to review your plan documents early in the year, proactively confirm whether you have the catch-up, Roth catch-up functionality or not. I did read something, though. There was a survey by Plan Sponsor Council of America, and they actually did find that about 95% of employer plans do offer the Roth 401k contributions as of the end of 2024, and that was actually up from about 92% the prior year. So it seems like a lot of employers are getting on board with these changes and updating their plan documents. So hopefully that would be available, for the individuals.
Yeah, I thought it was a much larger number of plans that didn't offer. I'm glad to see that many have sort of caught up a little bit here.
Yeah.
It's good to see. I think it's again, given all these changes, it's really important that some of these employers allow this capability for their employees.
Yeah.
Another question here is, how should I decide whether to prioritize IRA contributions in addition to maxing out my workplace plan? Excuse me.
Yeah, no. Great question. So, IRAs, and we're talking both traditional and Roth, they're great supplements vehicles because they can add tax diversification. They can allow planning outside of the constraints of an employer plan. So in 2026, the IRA limit moves to 7,500 with the additional 1,100 catch up for those 50 plus. So your decision should be, based on your income eligibility, whether your employer plan is already, maximizing those tax advantages, and how much flexibility you want in retirement withdrawal. So many clients really choose to contribute to both because it improves future tax planning options and strengthens overall retirement resilience.
And I'll echo that. I think it really is personal, right? I think it varies from client to client. And I think this is why it's really important to consult your advisor on these types of questions, right? I think we can give broad statements like this, but really it's going to depend on the individual. Can you afford that? Does it make sense? Are there other things that you want to do with those dollars that may be more important to you than the retirement outcome that you're trying to achieve? I think that's where these conversations with your advisor, your personal advisor, whether they be your accountant, your investment advisor, your wealth advisor, whoever it may be, your attorney, it does require these conversations. And I think it's really important. The more you have those conversations and the more time, early in the year you have those conversations, it just gives you that flexibility throughout the year. So I do think, I think Michael, you answered it really well, but I do think I'd just only add that it really depends on the individual situation.
Yeah.
So let me see if we have any coming in the door here during our Q&A. I don't see any kind of coming in unless I'm. Here's one. How do you make a contribution to an HSA account?
Yeah, so first, you may have an employer HSA account, so you can make a contribution through that company, and you may have one that's on the outside as well. So yeah, depending on who the provider is, I'm sure there's a process that you can make electronic or write a check directly to the HSA.
Yeah, and listen, as we get older, I think one of the things that it's going to catch up is as we get older, our medical care costs just tend to increase, right? There's more prescriptions, as our bodies start to break down. Candidly, I feel it every day, but it's tough, and I think that those HSA accounts are really valuable, particularly when we need those funds the most, and we tend to use those funds the most in our elder years. So yeah, I think the HSA strategy is a great one as well. I don't see anything more in our Q&A, so maybe we'll go back to some of the ones that came in here. Okay. So how can I figure out exactly how much to increase my contribution rate to reach the new maximum?
Yeah, so to reach a new maximum, I think a simple rule of thumb is really just to increase your contribution percentage, either by 1% or 2% of your salary each year. So especially when if you receive a raise, so it makes it a little less impactful from the budgetary standpoint. So for many people, this is typically enough to move, from their current rate to getting to that maximum, that 24,500, or higher if you're eligible for catch-ups. So in your payroll systems, typically employer plans, often allow for this automatic escalation, which means that your contribution rate will increase automatically each year without requiring you to take any action. So tools like this and like what we use, eMoney, we can also help, model your income, the pay frequency, employer match, to make a calculation of the exact percentage that you need to reach your goal. So, in this example, I think it depends, but we always, especially with retirement planning, we go back to what your overall financial plan looks like, and to leverage different tools, to see, what is comfortable with you and how you can, potentially make that 1 to 2% increase every year.
Yeah, and I think it's kind of one of the values. E-money is such a powerful tool; it can be used in so many different ways, and this is just one aspect of it. So, we're happy to make the sort of help you make that decision using some of the tools that we have at our disposal. So I don't see any more coming in. Maybe we'll go to the last one that was sort of submitted ahead of time here. If I can't afford to max out my 401k, what's the most important thing I should focus on? This is a great question.
Yeah, I would say the most important thing is to make sure you're contributing enough to get the full employer match. Don't leave that free money on the table, right? So it's essentially, as you get that free money, towards retirement, beyond that, even these small increases, like moving your contribution up that 1% a year, 2% a year, they can make a big difference over time without putting too much pressure on your monthly budget. So it all goes back to kind of, what feels comfortable to help you maximize the amount that you can contribute.
Yeah, and I think getting used to it, I think that's a really important point, that getting used to those contributions, making sure you do that as early as possible in the year so that you can effectively budget on the back end, I think is really important. Once you know that it's gone and once you know that it's contributed, I do think that is a big thing, for at least for me, when especially early in my career, I didn't even think about those funds. Those funds were sort of out of my usage, and they were allocated to those retirement spending. Now, again, it wasn't a tremendous amount of money at the in absolute terms, but at the time, that was a big part of, particularly early on in my career, is not thinking about those. And I think now I'm seeing the benefit, now that much later in my career, is because I did those automatic contributions and they weren't part of my daily living expenses. It really sort of manifested in a larger pool of assets than I would have ever thought that I potentially would have had just by doing those automatic increases over time. It really made a difference, and I'm thankful that I got some good advice early on in my career to do that. So I think I agree with you. It's really important to just sort of make those contributions as early as you can, getting that employee match, and really sort of moving upward on a percentage basis as you can, so that it doesn't put so much pressure on your monthly budget.
Mm-hmm.
So I don't see any more in the Q&A, and I think we went through all the questions that have been submitted. I know it's about 12:38, so we've gone through a lot of what we've gone through in a shorter period of time. I'll make one last request for any Q&A into the Q&A section here. So with that, I'll go once, twice, 3 times, and we will call it. So I want to thank everybody for their questions, both online and pre-submitted. This will conclude our Q&A and our webinar. Michael, I want to thank you so much for your time and really a lot of your valuable insights. I think your ability, as I mentioned earlier, to bring this to life and take these complicated issues and really translate them to actionable ideas were really important. So thanks so much, Michael.
Sure, it's a pleasure.
Most importantly, I want to thank everyone on this call for joining us today. We recognize that time is one of your most valuable assets, and we really appreciate you sharing some of it with us. We hope that this webinar is evidence of Bryn Mawr Trust's commitment to providing collaborative advice and planning to our clients and potential clients. Should you have any additional questions or just want to talk more about your individual situation, please consult your Bryn Mawr Trust advisor, or you can always contact one of us. Our contact information is now on the screen, and a replay link to this webinar will be emailed to you shortly after we end. So once again, on behalf of Michael and the entire Bryn Mawr Trust team, thank you for joining us. Enjoy the rest of your day.